earnings. For more on Morgan and also the big banks, we're joined this morning by JPMorgan Funds Chief Market Strategist David Kelly. David, by the way, is going to be staying with us throughout the hour, so we appreciate you taking up your time this morning. John, of course, with us as well. He's been covering the banks pretty much all this week. David, what did you make of Kevin's remarks about how trading is really less of a factor for Morgan, that you'd want to hold it because of its wealth management business?
Well, I don't want to talk specifically about any individual company, but in general, if you look at the investment banks, that business, obviously, Morgan Stanley seems to have some pretty good numbers this morning. But overall, there are some bumps. But if you look at financial services in general, there is improvement. In fact, of the 15 financial services companies that are reported through yesterday, 80% had actually beat estimates. 80%. So okay. I think that we're getting a few headlines of some disappointments, but the overall earnings picture, both from financials and actually overall, is still pretty good.
If you're bullish on the stock market right now, do you have to own banks? 5 years ago, there were 3 financials in the most heavily weighted stocks in the S&P: Citigroup, Bank of America, AIG. Today, it's only one: JPMorgan. Yay! But no, seriously, Apple is the dominant name out there. Technology are the dominant names. Do you really have to own the financials?
But you should, because if you think about what happened over the last decade, and we've had one black swan after another, one unexpected event after another, and you just need to be as diversified as possible. And banks have got a particular, niche type of investment. It's very, a bank is very different from Apple, and you just want to be very diversified. I do think that in general, financial services, they've been through a terribly rough time, but we are seeing improvement in a lot of lines of business for financial service companies.
But David, what's the compelling reason to be in financials or heavily in financials? Because as Kevin was just telling me as well, the reason why these banks are trading at book value or near book value is because there's this regulatory overhang. Nobody knows what's going to happen with the Volcker rule.
Well, yes, but we've also seen some political change here. So I don't want to talk about each specific regulation, but as we look at these regulations, as we move away from the disaster of 2008, common sense will prevail in a lot of cases, and these banks have got huge franchises. There's a huge need for financial services. People need financial advice, ways to invest more than ever before. So they've been through a lot, but when we look at the overall sector, it doesn't look particularly expensive. And I'm not sure that financial regulation gets worse and worse going forward. It may actually get a little bit better as we sort of try various things and realize, this is too restrictive. And we need to find ways of growing businesses in general.
What story do you think is going to sell the best over the next 6 months? Yesterday, Goldman Sachs came out and said our own trading of our own money was pretty good during the period, except we don't know, as you speak to, if regulation is going to change, if we're going to be able to continue to bank on that. Morgan Stanley comes out today. They've got this nice brokerage business, but it doesn't have the same kind of bang for its buck.
And those are both very volatile businesses. I think, but if you look at the banks in general, I think one of the big picture stories here is a decline in delinquencies. We've seen a huge decline in the consumer debt burden. Consumers are actually much better able to make their interest payments month after month than they used to be. That's bringing down delinquency rates. It will eventually bring down foreclosures. I think as they move from adding to loan loss reserves to reducing loan loss reserves, that I think is going to be the sort of dominant theme helping banks over the next few years.
Well, you were just saying, David, we've been up and up since August, right? Just hold that thought for a moment, because I do want to bring in Larry Levin of Trading Advantage at the CME. But David, go ahead.
No, well, that's right. And markets don't move in a straight line, but you've really got to distinguish between a market correction, which I think long-term investors should just ignore, and any change in the economic outlook. And the economic outlook is still getting better. That China number, for example, on a quarterly basis, we think that was over 12%, which is a lot stronger, obviously, than what's going on in the United States. That 10% number is a year-over-year number. Quarterly, it looks like more than 12.
Right, we're just like at 3.5% right now, or
if we get 3.5 for the fourth quarter, that'll be a good number.
Larry, what do you make of what David is saying, which is that we are anyway naturally due for a correction given this run-up we've seen?
I would agree with that. The one thing is, Betty, that we've been calling for a lot of people have been calling for corrections for a better part of a year and a half now and really haven't seen it. So this is the first time that I guess people are kind of proven right. But I would agree with what David's saying, that this market most likely is kind of taking this breather. I think we'll go down to about 1250, 1255 in the S&Ps and then recover and head back up and make new highs above that 1295 level we saw the last couple of days in the S&Ps. So I would agree that this is kind of just a breathing point, and then this market will pick back up. I don't necessarily say or agree that the economic factors out there are getting so terrific. For companies they are, but for consumers I'm not so sure. But for the most part, the market's ignoring what's happening with the consumer, going with what's happening for the most part with corporations out there doing well, and these markets continue
Larry,
to move higher.
just to jump in, I would add, you could argue that this earnings season and last earnings season, third quarter, have played out fairly similar to this point. From Alcoa reporting to Apple reporting, you saw a lift in the market. When Apple reported last quarter, we saw a bit of a breather briefly, and then continued higher, and we're seeing that so far, it looks like, in this.
But I also, Larry, I think there is something of a stealth rally going on in consumer spending here. I think when we see the GDP numbers next week, we're going to see over 4% growth in real consumer spending for the first time since 2006.
Right.
So I think consumers are coming back. It's not as spectacular as profits, but they are coming back.
Let me get back, though, to JPMorgan Funds' David Kelly, because I think this story by Shannon kind of illustrates a problem in some ways that healthcare companies face, right? They face regulatory environment and their drugs being rejected, but also this whole generic drug situation as well. And, you fail to see sometimes the compelling reason for why you would want to be in healthcare stocks. Is there one?
Well, healthcare stocks are not expensive, and that's the good news. But I mean, the other part of this story is, if you think about what's going on in Washington with the budget, and you think about healthcare reform was passed, and it helped out a lot of different constituencies, but it didn't control costs. And as we go into, over the next few years, trying to do something to bring the budget deficit down, I think we will see much more focus on costs. It's going to be hard for a lot of healthcare companies to dodge, biting the cost on that reduction in government spending. I mean, if you want to cover more people, but you don't want to spend more dollars, that is going to hurt healthcare companies. I think that's one of the things weighing over the whole sector right now.
But even that statement, though, David, is not for certain, because you just saw last night, for instance, the House saying that they're going to repeal health care reform.
And of course they're not going to repeal healthcare reform, but what they can do is they can limit funding for different pieces
you're saying
of
it's not
it.
Going to pass the Senate.
I think healthcare reform in general, the big bill, is safe for now. But over the next few years, both the administration and the Republicans in Congress are both going to be looking for ways to try and reduce the growth in healthcare costs. They have to. And ultimately, that can hurt doctors, it could hurt patients, but it can also hurt a lot of healthcare providers, drug companies. I think that's something that's just weighing over the whole industry.
So then, bottom line, then you'd want to stay away from them at this point.
But they are cheap. So I wouldn't be overweight healthcare stocks right now, but I'd probably be about level weight. It's not my favorite sector, but they are relatively cheap, and it helps diversify a portfolio.
David, what do you make of this? Which camp are you in?
I'm definitely in the bullish camp when it comes to this. First of all, I don't think that housing prices are going to drop significantly from here. We've got the best affordability we have ever seen. With mortgage rates still below 5%, home prices down about 25% from their peak, and disposable income is going up quarter after quarter, and that makes housing more affordable. So first of all, it's very affordable. Second of all, with regard to inventory, a lot of numbers are thrown around about shadow inventory. I mean, the numbers are this. There are 50 million mortgages in America today. About 4.5% of those are in foreclosure. That means 2.25 million houses. Of those, about a third are actually already on the multiple listing service. So now you've got about 1.5 million houses, which you can add to the existing inventory. Inventory right now is 3.8 million, roughly. Add 1.5, that's the shadow inventory. So it's not twice what the current on the market inventory is.
So how many years then would it take for us to work through that?
Oh, it'll take quite a few years, but the key thing is a normal level of housing starts, given our population growth, is about 1.6 million. We're at 29,000 on housing starts. We're at 1/3 of that. We're 1 million units short based on population growth. So yes, there's excess inventory, but there's also building pent-up demand of people who really ought to be buying houses now and who are waiting to see.
That's the question. How fast does demand come back? Because household formation, one of the keys to new home sales, really dropped off during the recession.
Well, yes, and obviously it depends a little bit on job growth, and it also depends on confidence. And we think confidence is gradually coming back, and it takes some confidence to buy a house. But from here, it's very, when things are this low in housing, the issue is not the level. The issue is the rate of change from here. We think housing in 2011 is going to go up rather than down.
So then, when you hear John Paulson, for instance, saying you should not buy one house but two houses because of this environment, is that something you agree with?
Yeah, if you can afford to, absolutely.
If John Paulson's on the other side of the train.
Absolutely. I think this is a spectacularly good time if you're starting out in life to buy a house. This is a great time to buy, not to rent.
You think that the prices continue to fall for a while, though? People shouldn't market time, but if they're looking to catch the bottom.
No, and on average, I don't think they will. Obviously, in some areas with excess inventories, maybe, but on average, no. And you try and market time the price, but you could miss out on the interest rates. That's the other thing. The Fed is not eventually it's going to stop being your friend here. You're not always going to have sub 5% mortgage rates.
It's been 25 months of record low interest rates. That's a long, long time. Especially for David, I think Steve is correct in the sense that the stakes are much higher for multinational companies. We need to see progress with the U.S.-China relations.
Absolutely, and I think often we have the wrong sense of the Chinese-U.S. relationship. This doesn't have to be a competitive relationship. I mean, economics is not like baseball. In baseball, if one team loses, the other one wins, and vice versa. But if China grows strong, if China is stable, if China moves forward on its current trajectory, that's probably good for the United States. And so I think it's good to encourage both more free trade, more.
And underscoring that is that every time something happens in China, with the markets go down considerably, then we get rattled here, and it's hard for you know what I mean.
Well, yes, but I have to say I always find this one a little strange. China grows stronger than expected, so people expect that the Chinese are going to slow their economy down, and therefore we should be worried because of slow Chinese growth, even though what they just reported was fast Chinese growth. I mean, I think we're taking it one derivative too far, to be honest. I think strong Chinese growth is good.